Journal Trust here. In this video, I'm going to break down 5 dividend ETFs plus a bonus that you want to have in your income portfolio because they will pay you the most monthly for 2025 and beyond. Okay, so the first one I have for you is KBW Premium Yield Equity REIT ETF. So the Invesco KBW Premium Yield Equity REIT ETF can be a compelling addition to an income-focused portfolio due to its high current yield monthly payments, right, or payouts, and focus on small to mid-cap REITs with competitive dividends. Financially, KBWY offers attractive yield metrics, though its long-term total returns and volatility should also be considered. I'm going to get a little bit into that a little later. So in regards to the high dividend yield and payouts, KBWY currently boasts a forward dividend yield of around 9.3% and a 30-day SEC yield near 9.26%, both significantly higher than broader equity averages. Now, dividends are paid monthly, supporting regular passive income for investors. Now, over the past decade, annualized total returns have averaged 3.7 to 4% at NAV, with periods of both outperformance and underperformance relative to broader real estate peers. So the ETF's price is $16.16 as of the latest close, with a current market cap of about 247.7 million. So KBWY invests heavily in small and mid-cap REITs, making it somewhat more volatile compared to large cap counterparts and the broader real estate index. Now, holdings include the Brandywine Realty Trust, Innovative Industrial Properties, and Community Healthcare Trust, right? All chosen for high dividend yield. Now, there are some risks and considerations when it comes to this ETF. Everything is not all sweet and honey, right? The fund's focus on small and mid-cap REITs increases exposure to sector volatility and company-specific risks, right? Recent years have seen periods of negative returns. For example, you have the minus 12.59% in the last year versus 1.04% for a broad real estate index over, right, a 3 and 5, basically over 3 and 5 years, returns have averaged less than its benchmark. Now, high yielding REITs, right, may face more market pressure during economic downturns, so asset allocation and risk tolerance should be carefully considered. So that's the first one. The second one we have is Global X Super Dividend ETF, right, SDIV. So adding the Global X Super Dividend ETF, SDIV, to a passive income portfolio may appeal due to its exceptionally high yield global diversification and monthly dividend payments, but also carries notable financial and technical risks that investors need to weigh carefully. Now, the high dividend yield, the SDIV, is known for its double-digit dividend yield, commonly ranging from 10 to 13% over the past year, far exceeding average yields from broader indexes like the S&P 500, which is about 1.3%. Now, for instance, a 10,000 investment could produce over 1,000 annually in passive income, or roughly $90 a month. Now, in regards to the global diversification and the passive income structure for this ETF, right? Basically, the ETF invests in 100 of the highest yielding dividend stocks worldwide, including sectors such as real estate, energy, financials, and emerging markets. Its holdings span common stocks, REITs, and MLPs, providing income diversification and regular monthly distributions, matching up to conveniently with basically recurring expenses. Now, here are some things to consider. The ETF is basically highly liquid and trades on NYSE Arca. It features substantial assets under management and consistent trading volume. Its expense ratio is about 0.58%, which is above average for ETFs and may eat into returns somewhat. Now, notably, SDIV focuses on high-yield equities, which can entail higher sector and geographic risk, including volatile areas like REITs, energy, and cyclical international stocks. So in the past, SDIV has struggled with significant capital erosion, right? Many reviews basically note that while dividends are high, net asset value has declined over time, impacting the total return and basically the sustainability of income. Now, the ETF's long-term performance shows its share price and distribution have basically fallen over the past decade, a trade-off for, the high payout, right? So that's something to keep in mind for that one. The third one we have is the Invesco S&P Small Cap High Dividend Low Volatility ETF, right? So basically, it's a 30-day SEC yield of around 7.23%, which is attractive for income-focused investors. So a relatively low expense ratio of about 0.30%, making it cost-efficient. Now, in regards to the price-to-earnings ratio, which is about 14.88, and price-to-book ratio, which is about 1.49, indicating valuation metrics consistent with a high, basically a value-focused dividend strategy, right? So the monthly dividend distributions, which is basically beneficial for regular passive income, the holdings are diversified across 60 securities, reducing individual stock risk and improving portfolio stability. Now, technically, the ETF exhibits less volatility relative to typical small cap stocks, which tends to smooth the income stream and reduce downside risk. So its portfolio includes companies with a proven history of stable dividends, and the fund is rebalanced semi-annually to maintain its investment criteria focused on both high dividends and low volatility. So the fund's historical performance shows moderate growth and durability in various market conditions, making it suitable for passive income investors who want exposure to small caps without excessive risk. The fourth stock I have for you, the ETF, is the Global X Super Dividend US ETF, right? DIF. So DIF targets 50 of the highest dividend paying equities in the US, aiming to boost portfolio yield through exposure to high dividends with monthly distributions. Now, this can enhance steady passive income compared to broader, lower yielding funds. So DIF is positioned in the style box, which is an all cap value segment, with a smart beta approach. So selecting stocks for dividend stability and yield rather than pure market cap weight. So the ETF seeks to replicate the INDXX Dividend US Low Volatility Index, adding some risk control by choosing dividend paying stocks with lower volatility. So the ETF typically offers a dividend yield around 6.7% to 7%, providing higher income than the broader market average. Monthly distributions help align income with typical monthly expenses for income investors. Now, price metrics show DIF trading with a price to earnings ratio near 12, which is relatively modest for an ETF sector focused on value and income, potentially indicating valuation attractiveness. So the fund has a market cap near 650 million, ensuring reasonable liquidity for trading and investment flows. Compared to Global X Super Dividend ETF SDIV that invests globally with a higher yield of about 10%, but also higher volatility and risks, DIF, on the other hand, offers a more concentrated US-focused strategy with somewhat more stable dividend yield, basically the income, but lower yield, right? So more stable, dividend income, but lower yield. So the downside includes some vulnerability to dividend cuts from individual components, typical in high yield strategies, and potential price volatility, especially in shifting interest rate and economic environments. The fifth one I have for you is the JP Morgan Equity Premium Income ETF, JEPI, right? Now, JEPI offers an attractive 12-month rolling dividend yield of around 8.3%, right? Or 8.13%, sorry, 8.13% to 8.4%, with a 30-day SEC yield of about 8.62%, providing a strong and consistent income stream for investors. Now, since the inception in May 2020, JEPI has delivered a total return of approximately 11.7% annualized. The ETF returned around 10.94% in Q2 2025, and year-to-date returns near 4.5%. It returns basically have been less volatile compared to the S&P 500 total return index, reflecting its focus on lower volatility stocks combined with option premium income, right? Now, in regards to expense ratio, JEPI has a comparatively low net expense ratio of 0.35%, making it cost efficient for the income it generates. Now, it is a little volatile, it's an ETF, right? The fund has exhibited lower volatility relative to the S&P 500 since its inception, through its defensive equity portfolio and covered call strategy that dampens market swings. Now, the fund invests primarily in large cap S&P 500 stocks with low volatility and value characteristics. So it generates income by selling out of the money call options on those stocks like the equity linked notes, creating additional premium income besides dividends. So this method allows for monthly income distribution even in sideways or bearish markets. Now, JEPI's option overlay strategy smooths income receipts and reduces drawdowns compared to pure equity ETFs, which is attractive in volatile markets and for investors seeking income stability. So the portfolio construction emphasizes risk-adjusted returns and diversification, actively managed to balance income generation with, capital appreciation prospects. JEPI tends to underperform in strong bull markets because call options cap upside gains, but this trade-off is justified by reduced market risk and steadier income. Now, the sector allocation and stock selection are managed to avoid high volatility sectors and favor reliable dividend payers supporting income predictability. Now, here is the bonus, right? Here's the bonus I have for you. We have Invesco S&P 500 High Dividend Low Volatility ETF. So that's SPHD. So SPHD invests at least 90% of its assets in common stocks of its index in tracks. So the ETF has a current price around $49 with a market cap exceeding 3.2 billion with a B, billion. So it has an expense ratio of about 0.30%, which is moderate and typical for dividend-focused ETFs. So dividend distributions are made monthly, providing regular income for investors. The price to earnings ratio is about 16.47, indicating reasonable valuation relative to earnings. The ETF's dividend yield is significant compared to the broader market geared towards income generation. So SPHD selects stocks based on both high dividend yield and low realized volatility, balancing income and risk. So it is rebalanced and reconstituted semi-annually, right? January and July, ensuring it adjusts to changes in volatility and dividend yields. Now, the top sector allocations include real estate, utilities, and consumer staples, which is sectors traditionally known for stable dividends. Now, top holdings in the ETF represent, key high dividend and relative stable companies like Crown Castle Inc., Altria Group Inc., and Verizon Communications Inc. The ETF has a beta of about 0.71, meaning it tends to be less volatile than the overall market. Now, the year-to-date returns are around 3.45%, with about 9.46% in the past year, reflecting moderate growth with income stability. Now, over the long term, the underlying index has delivered annualized returns of around 9.10%, which is solid for a dividend-focused strategy. So that's what I have for today. Please take a moment right now to hit that subscribe button and the like button. If you like this video and you want more videos like this, hit that subscribe button, hit that notification bell. Also, let me know your comment section. Like, is there an ETF you think that is better that I missed? Let me know. I appreciate your viewership. Stay safe and see you on the next video.